Hello, and thanks to everyone watching. This is Rick with Fortress Federation Investments. If you're on this call, chances are you know me. Today we are presenting VenicePARK, formerly known as Avenir on Monterey. This is a 243-unit Class B asset located in an affluent submarket of Venice, Florida. Some quick insights. For those that have invested in our other Florida opportunities in the past, you know that our Sarasota County properties have performed really well and may have been waiting patiently for another opportunity. I've been waiting also, and I'm happy that we can finally deliver another investment opportunity with some of the same fundamentals and the same team that we've had so much success with. I'll briefly touch on some things that really stand out about the deal. First, there's a ton of demand in this area, as you'll see, coupled with an extremely limited competing supply. That's really it right there, that supply and demand. This has resulted in long waiting lists for this property and its competitors, and lease renewals and new leases are up 35% over current rents, which is about a $500 increase without any sort of renovations. Secondly, it has a conservative debt structure on it, as we were able to secure a fixed rate of 5.64% with very low leverage. So this protects us in this interest rate environment that we find ourselves currently in. Also, we have very low break-even occupancy of 63%. In a moment, I'll touch a bit on Hurricane Ian and how that has actually had a positive impact on this area, as it has resulted in displaced residents looking for housing, which is driving up occupancy, as well as construction workers being brought in to repair the area down south. But first, quickly, a disclaimer. We are presenting information that we've gathered through our own research. You are encouraged to do your own due diligence. This is not the official offering. That will all occur within the investor portal, where you can find the private placement memorandum and subscription agreement. And I'll let you know how you can access that on the portal toward the end of the presentation. I'll introduce the team here in a moment, but first a general summary of the opportunity. So we have a recession-resistant B-class asset in an outstanding location in Sarasota, MSA. VenicePARK is located near 3 other assets we own to the north. And like I mentioned, they're all performing well. This specific location has a strong median income of $68,000 and top-rated schools nearby. We were able to purchase this asset at a 15% discount from its original asking price. This was more than a $10 million reduction in the price. So when we talk about risk, leverage, or the debt, is a key component of that risk. Since we've secured a fixed rate with Freddie Mac, we have no exposure to any upward interest rate movement moving forward. As I mentioned, current rents trail market rents by $200 plus. And as I also mentioned earlier, there's a very limited supply of competing product, while growth and demand for apartments continues to grow. So this fundamental high demand, low supply sets us up well to succeed. And finally, we are targeting a close in December of 2022, which will ensure that we can take full advantage of the final year of 100% bonus depreciation. I know many of you like to take advantage of the tax efficiency that real estate offers, so it is important to point out here. So we are offering an 8% preferred return to investors, which means investors receive the first 8% of all cash flows on an annual basis prior to the general partnership receiving any of the profit. Anytime this 8% is not achieved, the balance will accrue and be paid out at a sale or refinance. After the 8% preferred is met, the profits are split 70% going to the investors and 30% going to the general partnership. We are projecting an IRR of 15.2% with an annualized return of 19.7%, which includes the profit at sale. We will be paying distributions monthly to investors. The minimum investment amount is $75,000. And now a note on the funding deadline. These Florida deals have filled up anywhere from 3 days to 2 weeks. So I encourage people to fund their investment no later than October 26th, even though it says October 31st on the investment summary. Maybe even sooner, just to not have a situation where you are on the outside looking in. And finally, we are targeting to close by the second week of December. Next, we have some background on the sponsorship team. I'm Rick Martin. I've been investing in real estate since 1997. I'm the founder of Fortress Federation Investments, and we provide value-add multifamily investment opportunities in the Southeast, Texas, and Arizona to help investors build their wealth and develop income streams. Fortress Federation is currently a general partner in 2,200 units. I passively invest myself as I'm an LP in 2,500 units. And I also really enjoy the process of guiding and educating investors. And you can go to our website at www.fortressfederation.com to get more information on that. And with that, I'm going to hand it over to the guys.
Okay, so good evening, everyone, and thank you for joining tonight. This is Warren Dresner with Equity Yield Group. At Equity Yield Group, we currently hold more than $150 million of assets under management. We focus on institutional-grade multifamily assets in great markets, sourced, qualified, and managed by an experienced team. I've been investing in real estate since 2010, and prior to that, have a background in finance and insurance. In addition to being a GP in multiple multifamily syndications and a managing partner of Equity Yield Group, I'm a passive investor as well, a passive investor in more than 20 syndications. So I understand the perspectives of being both a limited partner and a general partner in syndications. And I'm joined tonight by Ryan, and I'll let Ryan introduce himself.
Thank you. Hello, for those who don't know me, I'm Ryan Webster, a real estate professional and entrepreneur. Prior to founding Equity Yield Group, I owned and operated a Midwest-based construction development company. I'm a National Home Builders Association award-winning home builder and have a variety of project experience ranging from ground-up development, value-add multifamily, and commercial redevelopment. And I'll pass it back to Warren to dive into the details of this opportunity.
Cool, thanks, Ryan. So we're bringing in a third-party property management company to manage the day-to-day operations on VenicePARK. And this is a company that we know well, ResProp. ResProp currently operate 3 other assets that we own in the same market. What we really like about them is that in a previous life, they were owners themselves. And so they really understand the owner's perspective. Now, this is the 4th asset that we'll be buying in this specific market. And this will be the 4th time that we're working together with ResProp. So it's the same team that's been successfully working together and will continue to work together on this asset. This team also brings local operations and knowledge, given that most of the team live in Bradenton and Sarasota. Some even live at our other properties. And speaking of our other assets, we own 3 other assets in the MSA, and you can see on the screen the locations of Shoreview Apartments, Bradenton Reserve, and Oakwood Apartments. They're all on the north side of the MSA. VenicePARK's located around 30 miles to the south. You can see it on the screen at the bottom. Now, we really know the market well and have experienced firsthand significant population growth and high demand for housing over the last few years. And we thought it'd be useful just to give an overview of the performance of a couple of the most comparable of these assets. So Oakwood Apartments was acquired in March 2021. And you can see on the right-hand side of the page, the blue bars are the renovated rents that we had in the pro forma at acquisition. And the orange bars are the rents that we're achieving today, some 18 months later. We've really outperformed on this one, and so much so that we were able to refinance into fixed rate debt on this asset after only 14 months of ownership. In the process, we returned more than $5 million of capital to investors. So this one's been and continues to be a really strong performer. Bradenton Reserve is probably the most similar asset to VenicePARK. It's a B-class 166 unit community that we purchased in September 2021. Again, you can see that we're achieving rents well in excess of our pro forma rents. And this is really being driven by strong demand for the limited available housing in the market. So we have firsthand experience of this market. We've seen the growth. We really understand the demand and supply factors in the market. And we'll be executing the business plan on this asset using the same asset management and property management team that's been so successful at our other properties. Now let's talk about the market. anytime we look to acquire an asset, we start with the market and the sub-market. We remain really positive and excited about this market. Given our experience there, we're seeing firsthand the amount of migration into the area, growth in population and businesses, and how strong demand for housing continues to be. And we'll get into further detail on these points in the next couple of slides. Now, there's a large population in the Bradenton, Sarasota MSA, more than 830,000 people. The population's grown more than 19% in the last 10 years, as more and more people migrate to the area for work and lifestyle, as more and more snowbirds relocate, and as more and more retirees move to the area for a better retirement experience. Going forward, this population is expected to grow by 22% in the next 10 years. This population growth is driving income growth, which in turn is driving rental demand and house price growth. The median income in the MSA was more than $90,000 in 2022, according to HUD, 10% higher than the Florida average. And this figure has grown by 37% in the last 5 years. And it's really an attractive place to live. You can see that there are a lot of highlights that we can talk about. The MSA has been named #1 best place to retire in the US, best city to launch a small business, best beach in America with Siesta Key. The list goes on. Now, Venice, which is just south of Sarasota and north of Northport, is infamous for being known as the shark tooth capital of the world, which attracts tens of thousands of tourists every year to the area. You can see some of the shark teeth and the baby shark teeth that can be collected on the beaches on the right-hand side. And each year in April, there's a Shark Tooth Festival, which brings thousands of people to the area as well. The actual town of Venice is really a quaint town, but growing. As you can see in the circle in the middle of the screen, the MSA has grown by 18% since 2010. The county has grown by a little over 14%, but the city of Venice has grown by more than 22% since 2010. And what we're starting to see more and more of is that rent levels up in Sarasota are starting to cause some affordability issues. And more people are moving south in search of a more affordable option. And Venice is a big recipient of that extra demand. And you can see that the Venice submarket has some great statistics, even amongst some of its high-performing Gulf Coast peers. Here in the table, we're showing historic population growth as well as projected population growth to 2026. And Venice is second on the list of Florida Gulf Coast locations. If we look through the other categories in the table, there are very high incomes, as we'll talk more about in a moment, as well as a high proportion of white-collar residents and strong home price growth. It's really strong across the board. Importantly, the supply of housing has not kept up with the growth that's been seen in Venice. And this is most evident by the graph at the top, where we show population per existing multifamily units. And you can see that Venice now has the lowest relative supply of all locations on the Gulf Coast, further emphasizing the need for more housing in the area. And we've been seeing sustained growth into the area for more than 2 years now. We've shown some of these data sources before. On the left-hand side, we can see from the National Association of Realtors that the Sarasota MSA came in 4th in the most popular moving destination for families. In the center, we show data from the US Postal Service. And this one's interesting because it shows migration during COVID in 2020 and compares it to migration the year before in 2019. Now, if you're in the top right-hand side of the chart in the center, that means that migration was strong in both 2019 and 2020. And again, you can see Sarasota right up there as the second strongest in the US. And finally, on the right-hand side, we have a publication from U-Haul and their top 25 US growth cities. And this time they focus on Northport, which is on the southern side of the MSA. So clearly, the MSA is an area with significant in-migration, and that has been what's driving demand and rental increases across the whole area for a couple of years now. And one more source, just to highlight that the growth hasn't stopped in 2022. A recent pod study showed that Sarasota ranked first in where people are moving, ahead of Dallas, Nashville, and Tampa. So we expect continued population growth and high demand for housing going forward. From the Bureau of Labor Statistics, the MSA has a large workforce despite lacking any one major industry. Job diversity is really strong. And you can see the breakdown of employment here. The 3 largest industries are trade, transportation, and utilities. education and health services, and professional and business services. And this speaks to the economic resilience that we saw in the area and at our other properties, specifically throughout COVID, where economic vacancy only had a very small impact. And unemployment numbers have remained better than the national average as well. July 2022 unemployment stood at 2.7%, which is materially lower than the national average of 3.5%. In terms of employers, there are a number of large employers in the immediate area. Tervis Tumbler and PGT Innovations are two local companies that employ about 2,500 people. And then healthcare is an important industry in the area as well. There are a number of health facilities nearby, the most important of which would be Sarasota Memorial's new Venice location, which is a new development that already employs another 2,000 people. Given proximate location to Sarasota, we know that a number of people that live in Venice do commute the 20 to 30 minutes up to Sarasota for employment as well. And we'll touch on that further in a little bit. Okay, so let's start to look at the actual property. You can see that it's a well-presented property, mid to late 80s construction, but the current owners have done a really good job maintaining the property, and there really isn't much in the way of deferred maintenance that we need to take care of. There's a dog park, 2 swimming pools, a gym, which we will be improving. The interiors are fine, but they're dated. As you can see, they can do with some freshening up, and Ryan will talk more about the business plan and how we plan to update the units to attract tenants and take advantage of market demand. In terms of unit mix, it's a mix of 1s, 2s, and 3s with 27 larger 2-bedroom townhomes as well. All units have washer and dryer hookups, and all but 26 have the washers and dryers themselves as well. It's a large property with lots of open green space. There are a number of golf courses nearby, and the location really provides a nice and peaceful place for residents to live. You can see the 5 floor plans. I won't go into too much detail now, but this will be in the deck and you can take a look at these in more detail later. The location of the property is interesting. Many amenities are nearby, and actually we can point to a number of single-family home communities with price points a fair amount higher than our price per door. Some of these are up to $600,000 and $700,000. But let's talk about demographics. If we focus first on the map in the center, you can see in the different shaded census tracts the median incomes in the area. In the light blue section where the VenicePARK box is, the median income is in excess of $68,000 in the immediate area. Within a 1 mile radius per CoStar, on the table on the right-hand side with the orange circle, the 1 mile radius median income is more than $70,000. The average household income is actually above $100,000. Now, at the actual property, which is shown in the box on the bottom right-hand side, the median income of residents is $65,000. The average is $92,000. And the income to rent ratio is very healthy at more than 4 times the rent levels. So affordability is not an issue, and there is plenty of scope to increase rents. In the center at the bottom of the page is the niche.com rating for the area. Overall, Niche give it an A- and an A for public schools. And you can see a number of the schools that service the area are all rated A. One of them is even A+. And in terms of employment, at the actual property, the residents currently living at the property, you can see a large mix of industries. As mentioned, healthcare is a major feature. It's the biggest industry at the property currently. And on the right-hand side, we show geographically where the current residents work. A number work nearby around Venice and Osprey, but there are also a number of residents that commute to Sarasota. It's really only 20 to 30 minutes away. And given the more affordable nature of the property, it's not surprising that people want to live in Venice, even if they do work in Sarasota. And we expect that trend to only increase over time as residents search for better value in their housing. And speaking of value, I will pass it over to Ryan now to start to discuss the business plan.
Thank you. As Warren has discussed, the market, submarket, and location of this property is phenomenal, all of which present a fantastic opportunity to capitalize on further market growth and property performance. The property has historically outperformed the market and is currently realizing lease trade-outs of 34 to 37% on both new leases and renewals, driven by high income to rent ratios and strong demand for quality price point housing. We plan to burn off the existing loss to lease and close the rent gap to the Class A properties in the area by repositioning the property through a strategic renovation program, which will deliver a product with better amenities and more modern unit interiors to meet the strong demand for renovated B-class properties in the area. We conservatively plan to hold the property for 5 to 6 years and will renovate and stabilize the property on a 36-month schedule. We have set up a capital structure that gives us the flexibility to exit between 3 to 7 years, either by supplemental loan, free and clear sale, or sale with assumable debt. Our asset management team will monitor both property and market performance to make a strategic exit that is in the best interest of our investors. The scope of our interior renovations is very similar to the renovation programs we have successfully executed on our other properties, and is focused on cosmetic upgrades that provide the most value to prospective residents. We plan to improve the kitchens by adding quartz countertops, undermount sinks, and tile backsplash. Additionally, we'll paint the existing cabinets white and install brushed nickel door pulls and add recessed LED lighting to the kitchens, providing a more modern design. We'll add LVP flooring to the wet areas and a more modern framed mirror over the bathroom vanities, and repaint the walls with an updated color palette. After touring the property with our operations and construction team, I can say that I'm very impressed with how well the property has been maintained. There's no deferred maintenance, and major capital projects such as replumbing water supply lines, exterior painting, repaving the parking lot, and adding washer-dryer hookups have all been completed. There's more information on the impact of Hurricane Ian and general hurricane risk in the appendix. But given the age of the property, there's an opportunity to improve the community amenities. We plan to add an outdoor kitchen, convert an existing laundry room into a fitness center, add a dog wash station, construct vinyl dumpster enclosures, replace the pool furniture, resurface pool patios, add poolside cabanas, and improve the landscaping. We also plan to execute a strategic rebranding to improve the overall marketing, web presence, and property signage to better fit the resident demographic. Additionally, we have an opportunity to boost revenue by implementing valet trash service across the property. The property presents a great opportunity for rent growth and forced appreciation because of the way the local housing market has developed. There are only 6 80s to 90s built communities in the submarket, and only 3 within a 5-mile radius of the property. All the immediate comps are historically 100% occupied. Capri Isles runs a multiple-year waiting list. Woodmere is 75% seniors with a similar waiting list, and Clubside is an inferior Cardinal-built product, leaving very few options for renters looking for better quality price point housing. In the last 19 years, VenicePARK is the only one of these properties to be fully renovated and has historically outperformed the market in rent growth. Due to the delayed market development, rental housing in the area is primarily made up of late model Class A properties, which have put tremendous demand pressure on the limited Class B properties in the area. And the market is now primed for the beginning of a value add cycle as the B-class properties in the area begin to renovate. Woodmere has 6 renovated units, proving out $250 rent premiums, and plans to ramp up its renovation program over the next 2 years. Capri Isles has 3 renovated units, proving out similar premiums, and a long resident transfer waiting list for these units. Over the next 2 years, we expect to see residents leaving these long wait lists and moving into any renovated units available. VenicePARK, with its superior location and planned renovations, is well positioned to meet the demand for renovated product in the area. As you can see, there's a significant pricing gap between the Class A properties and the Class B properties in the area. VenicePARK has proven that there's high demand for more affordable renovated product in the area. Single working professionals have little affordable options available to them, as they are aggressively priced out of the Class A properties. And existing Class B properties are primarily poor quality product with little to no availability. Currently, there is almost a $700 premium between rents at VenicePARK and the Class A properties in the area. And our post-renovation pro forma rents represent an almost $600 discount to rents at these properties. We see this pricing disparity and an affordability component across the 2-bed units as well, with up to a $385 delta from our renovated pro forma rents. And given that Capri Isles and Venice Park are the only B-class properties that offer 3-bedroom units, these units show the highest ceiling with up to $600 delta from our renovated pro forma rents. The historically low deliveries of new product has created a market environment that fuels rent growth and lower vacancy rates. The market has seen 16.3% rent growth over the last 12 months, and market vacancy stands at 4.2%. In the last 12 months, there have been no deliveries of new product. Currently, there are 1,100 new units scheduled to be delivered to the market over the next 24 months. But the majority of these units are horizontal build-to-rent product, with market rents between $2,600 to $4,600. None of the scheduled new deliveries are affordable housing and will put further upward pressure on rent prices and increase the comparative value of Venice Park and the limited B-class properties in the area. The ever-rising cost of construction and the predominantly A-class makeup of properties in the area makes Venice Park an irreplaceable asset. The replacement cost for housing in the area is about $410K per unit. Venice Park and the limited B-class properties in the area are the only properties with a cost basis low enough to meet the affordable housing demand in the market. And at a time when inflation is rapidly eroding the consumer budget, the need for quality, affordable housing options has never been greater. At $256K per unit, we not only have a significant discount to replacement cost, but we also have a discount to recent trades of older, inferior product. Autobahn, a 1957 built community, traded at over $300K per unit back in July of 2022. And Parkside East, a 1975 built community, traded at $260K per unit back in June of 2022. The structure of this deal provides investors an 8% preferred return and a 70-30 split thereafter. All investors will share in tax benefits from depreciation, cost segregation, and paper losses, as well as receive monthly cash flow distributions beginning in the second quarter. Sources of capital for the project will consist of a $34.9 million fixed-rate agency loan with Freddie Mac, a $16.2 million preferred equity contribution from our private equity partnership with related companies, and a $19.1 million common equity investment. And the key principals will be personally investing at least $1 million into the project. The use of funds for the project consists of $62.3 million to the purchase price of the property, $3.3 million in capital expenditures, $1.6 million in closing and soft costs, $1.5 million in working capital and contingency, and $1.2 million in acquisition fee. At Equity Yield Group, our primary focus has always been to mitigate risk in our investments. And in doing so for this project, we've built a very conservative fixed-rate structured capital arrangement. The senior loan is a fixed-rate agency loan with Freddie Mac at 56% loan-to-value, a 10-year term, 5 years interest only, and step-down prepay. We've rate locked this loan at 5.64%, which is lower than the market rate available today. Additionally, our private equity partner has provided favorable terms on a fixed-rate preferred equity placement with a total cost of capital of 11.5% and no participation in upside, and a favorable cash flow waterfall allowing investors significant participation in cash flows. The combined DSCR for the senior loan and preferred equity is 1.56, and the combined loan to cost is only 72% leverage. Average cash-on-cash returns for the project is 6.1% annually. Total project returns range from 13.9% to 16.6% IRR, or 17.4 to 22.2 average annualized return, depending on our cap rate at exit. Our median exit cap rate is conservatively set at 4.9%, while CoStar has a projected 4.7% cap rate for B-class properties in our projected year of disposition. Investors will also receive their share of tax benefits, and 2022 is the last year to take advantage of 100% bonus depreciation. Our third-party tax consultant has estimated these benefits to be 59 cents per dollar invested in year one and 85 cents per dollar over the life of the deal. The project will provide investors with year one cash flows projected to be at 5.1% and grow to 7% annually after completion of renovations. Reviewing the key details for this project, the property is a 243-unit community built from 1985 to 1988, located in the city of Venice in Sarasota County, which is 30 minutes south of our other owned assets in Florida. The market vacancy is 4.2%, and the break-even occupancy for this project is 63%. And our conservative capital structure provides a combined 1.56 DSCR for the senior loan and preferred equity. The fees for the project consist of a 2% acquisition fee, 2% asset management fee, and 2.5% property management fee. Now, to summarize why we're so excited about this deal and why we think it's a great investment for the current market conditions, it provides an opportunity to invest in a hard asset with strong risk-adjusted returns and a recession-resistant B-class property. It is located in a phenomenal market with a $68K median income and $71K within a 1-mile radius of the property. The property has an impressive existing income to rent ratio of 4.21. Additionally, the location boasts A-rated schools and is a market we already operate in and have seen performance well exceed our expectations. We've been able to purchase the property at a 15% discount, $10.7 million below initial pricing guidance, and we've secured a low-leverage fixed-rate loan at below-market interest rates. The market has a structural undersupply of price point housing and has seen 25% population growth over the last 12 years, and is projected to see over 11% in the next 5 years, priming the market to fuel future rent growth with a property that's already trailing market rents by over $200. Lastly, we're excited to close this deal before the end of 2022 to take advantage of the last year for 100% bonus depreciation. The deal provides investors an 8% preferred return and a 70-30 split thereafter, with monthly cash flow distributions. Median projected returns for the project are 15.2% IRR, or 19.7 average annualized return, and the potential for up to a 16.6 IRR if we exit at CoStar's projected cap rate of 4.7. The minimum investment is $75,000, and our target hold period is between 5 to 6 years, although we will consider any exit that is in the best interest of our investors. The funding deadline is October 31st, and our target closing date is December 12th.
All right, just quickly, a few words on Hurricane Ian, as this could be on some people's minds.
We wanted to include some additional detail around Hurricane Ian and hurricanes in general. Now, Hurricane Ian was devastating, particularly for the Fort Myers community and some of the barrier islands nearby. But actually, hurricanes making landfall in this part of Florida is quite rare. There have been only 4 in the last 150 years, and Ian was by far the worst of those. It was a big event, but we don't expect these types of events frequently at all. In terms of damage, we've been out there to inspect the impacts in and around Venice, and the typical damage that we've seen has been landscaping, fallen trees, broken fences, missing shingles, missing downspouts. All of that's been relatively common. There's been some isolated cases of roof leaks and broken windows, but that's definitely less common in the Venice area. And then finally, there actually is a silver lining to some of this. Although the impacts have been devastating to some parts of the state, we're actually already seeing an increased demand for rental housing as a consequence. So there are actually, this includes some displaced residents with FEMA vouchers who are now looking for housing where they can, as well as traveling contractors who've come into state looking for work. And we expect that increased demand is going to last for the next 2 to 3 years. So there are actually some positive impacts as well in terms of owning assets nearby that we expect to see at this property, as well as our other properties further north.
All right. So what happens after you've invested in the deal? You'll be receiving monthly progress reports on the property, business plan, as well as market updates, and you'll also be receiving quarterly financials. You're going to get monthly distributions after the first quarter of ownership, and your preferred return begins to accrue from the day of closing. We definitely pride ourselves on our communication and transparency, so we're always available to answer your questions or address any concerns. If you are interested in this deal, it's important to expedite the next steps. If you haven't invested with us in the past, you'll need to register on the portal first, More on that in a second. And then follow the steps of creating your user profile and expressing the amount that you would like to invest. You'll need to review the private placement memorandum and complete the subscription agreement, and this is all done electronically. We'll review and accept your subscription, and then you'll be provided wiring instructions to fund your investment. We'll confirm receipt of your wire, so we'll follow up with you. So next steps, the investor portal. So you can click on the Fortress Federation Investor Portal link right there in the right-hand corner of the page there. You'll then enter your name and password or register if this is your first time. And then once you click on Invest on the left-hand side, this takes you to the offering, and then click on that blue button there on the right that says Invest, and you'll be led through the steps of subscribing and funding. So finally, we have an appendix with some sensitivity analysis showing scenarios at different cap rates and changes in occupancy, as well as a pro forma that you can go over at your own pace. It's all there in the investment summary. And there's my contact info. Should you have any questions, certainly reach out. You can set up a time, no problem. And I'll just say one more time before we get into Q&A that it's becoming more rare to find good deals that actually pencil in this lending environment. I can't really say when our next deal might come. So if you're on this call and you have interest in investing, don't hesitate, as it's rare to find deals with such a conservative debt structure that still offers great returns. So if you decided, I encourage you to move forward quickly, as like I mentioned, these Florida deals have filled up anywhere from a couple days to at most a couple weeks. Okay, with that, we will open it up to Q&A, and if you have questions, click on that Q&A button there at the bottom as opposed to putting them in the chat.
So Ryan, one question here is, what reserves are you raising to hold at the property? Can you talk a bit about the reserves we're expecting?
Yeah, absolutely. So we have a number of reserves for a few different purposes. We have contingency for our renovations of about $250K. We have some soft cost contingency of about $350K. We also have general operating capital of additional $450K.
What are the top 3 reasons why you like this deal?
Yeah, I'll give you mine. Yours may vary from mine, but I think the first thing is really it is a market that we already operate in and are very familiar with. And then the next piece, kind of given the volatility in the debt market, I really like being in a fixed rate debt product where we have the predictability of knowing what our mortgage payment is going to be. And then this is the last year for bonus depreciation. So it's nice to get one done before that starts to phase out.
Yeah, my answers would be similar. I'd say the supply and demand dynamics is a huge benefit to owning assets in this market. That would have to be one reason. I think the debt as well is a major reason why I like this deal. Not only is it low leverage, but fixed rate, like you say, so we don't have that interest rate or refi risk. Can you explain how FEMA vouchers work?
Yeah, absolutely. So when you have these large catastrophic events, FEMA is a federal agency that offers relief to people who live in these areas. So say your house was completely destroyed, you can go to FEMA and they'll offer temporary housing vouchers for displaced residents while they wait for their homes to be rebuilt or to relocate to somewhere more permanent.
When do you expect monthly distributions to begin?
Yeah, so we'll begin in the second quarter, somewhere between 3 to 6 months in after closing. We really want to do a couple things. Want to verify the execution of the business plan in the beginning months and make sure we're on track before we start bleeding money off the operating account.
Okay. Will there be a disposition fee on this deal?
Yeah, no disposition fee on this. We like to keep it simple for our investors. So it is just an 8 pref and a 70-30 split thereafter.
And the fees were all disclosed on the one page. So the only fees are an acquisition fee, an asset management fee, and then a third-party property management fee that we pay to ResProp. That looks like all of the questions. So last chance if anyone's got a late question to ask.
Okay, I think that wraps it up. Any more questions? Let us know. Going once. All right. I want to thank everybody for being on this call. Thanks to Ryan and Warren. And we look forward to partnering with you. If you have any questions, please reach out.